Welcome back. A while ago, we asked you to send in any questions you might have about housing and mortgage-related debt. Many of you did so, and here to answer those questions is our expert, Doug Hoyes. He's a licensed insolvency trustee with Hoyes, Michalos Associates, also the author of this book, Straight Talk on Your Money, the biggest financial myths and mistakes and how to avoid them. Let's get to your questions to Doug. Here comes an email from Stephen in Mississauga. Myself and my family of 5 are part of the group of Canadians that are struggling to pay their mortgage. The sole reason is due to an increase in rates from 3.69% to 5.69%. This has resulted in a 43% increase in monthly mortgage payments. It now puts our family into a situation where a very high percentage of our monthly wages goes directly to the mortgage payment. This has caused a greater reliance on credit cards to cover other general expenses. I'm fearful of my mortgage renewal in 2025. What happens if the bank chooses not to renew? So there you go.
Well, and this is a very common issue, and a lot of people are doing exactly that. I'm getting behind, so I'm resorting to credit. So now not only is my mortgage high, but so is my other unsecured debt. Now, the first issue, will the bank refuse to renew your mortgage? If you are with a traditional bank, one of the big banks, they are in the business of doing mortgages. You've had the mortgage for a few years, so you've paid it down a bit. It's highly unlikely that the bank is going to say, oh, we don't want your mortgage anymore. Mm-hmm. They are in the business of doing mortgages. They spend a lot of money acquiring new clients. They're not just going to get rid of someone, provided you're up to date. It's not like the real estate market has crashed and the house that you bought 5 years ago is now worth a lot less than when you bought it. So there's probably more equity in the house now than when you originally purchased it. So it's unlikely that a traditional bank is going to say they're not going to renew. Now, what they probably will do is say, hey, the interest rate's a lot higher. So that's something you want to factor in. Now, if you have a mortgage with a private lender, which I don't think this questioner has, but a private lender mortgage would be, hey, I was trying to close the deal, the bank wouldn't give me so I had to go to a private lender, much higher interest rate. Right. Those deals are typically 1 year in length and much higher interest, and they don't want to be your mortgage holder for forever. They're a bridge. That's where you potentially could have problems where the private lender says, no, I'm not going to renew it. So my advice would be, when your mortgage comes up for renewal, don't wait till the last day to start thinking about it. 2 or 3 months in advance of renewal is when you want to be talking to your lender, to mortgage brokers, find out what's out there and decide what options you've got so that you're well prepared for it when it hits. Okay. Let's go to another email. This one comes from Leduc, Alberta, from Robert in particular. We are seniors in our mid-80s. When we bought our home 9 years ago, the bank recommended we buy it using a personal line of credit. The home is a bungalow with a value today of about $485,000. The line of credit is $200,000. The result of higher inflation was a disaster for us as our bank payment went from $500 a month to $1,340 a month. He seems to be saying that inflation brought on higher interest rates. Higher interest rates caused the mortgage payments to rise. Last year, I gave the bank over $15,000 in interest on a pension of under $20,000. That sounds like what Robert's income is, his primary income, a pension of under $20,000. You would assume he's also getting Canada Pension Plan and perhaps old age security as well. We don't know that for a fact, but that would be a reasonable assumption. Do not know what to do. So the basics of this situation is a senior on a fixed income, and it sounds like a fairly modest one, with mortgage payments that have come close to tripling. Yeah, and if you do the math, okay, $200,000 line of credit, interest only, the interest rate for a $500 a month payment was probably around 3%. Now it's more like 8%. And so problem number one with a home equity line of credit is the interest rate changes every month. And if it's an interest-only payment, the payment changes every month. And so as Robert has said, yeah, my payment has gone way up. So what do you do? Well, if his income truly is $20,000 a year, he cannot be paying $15,000 a year just on his mortgage interest. He's got to buy groceries and pay property taxes and all the rest of it. So what are his options? Well, option number one would be to see if he can convert his home equity line of credit into a fixed rate mortgage so that the payments are spread out over a longer period of time. Now, does that make sense for someone who's in their mid-80s? And will that even lower his payments? Maybe not, but that would be the first option to consider. The second option to consider would be a reverse mortgage. So if he's got a house that's worth around $500,000, well, he could borrow potentially up to $250,000 on a reverse mortgage. He uses the first $200,000 to pay off the existing line of credit, and now he has no monthly payments, and he's got $50,000 in the bank. For someone in their mid-80s, that's a better option than for somebody in their 60s, because they're probably not going to be paying a massive amount of interest. The third option would be to say, hey, is this the time for us to sell the house and move into something perhaps a little bit easier to maintain, a rental property, something like that? Because again, if you sell the house, he's going to put a couple $100,000 in the bank. That will certainly cover his rental payments for many, many years.
Right.
That may be a simpler and much less risky option.
Okay. Let's go to our third email question. This one comes from Saeed in Toronto. We bought our house close to 4 years ago here in Toronto. We took a 5 years variable mortgage at less than 2%. I clearly remember when the Bank of Canada governor said they would not increase rates anytime soon. And sure enough, shortly after the Bank of Canada started increasing and increasing, my rate is now over 7%. Every month. We borrow more and more, just adding to our debt. We also lost all our savings in the stock market. That's a separate question. We cut whatever we could, driving only one old car for now, for both of us, my wife and I. We have 2 kids. Our grocery bill is much higher. Everything is more expensive, even our property tax. Our renewal is in a year, and I don't know what to do. These stories can become very, very sad. This one sounds dire.
Yeah, and I totally sympathize, because if you go to the big Google machine and type in Tiff Macklem said he wouldn't increase interest rates, the first hit you get is a BNN Bloomberg story from July of 2020, where he had a press conference and he said interest rates are low and they're going to stay low for a long time. So it's natural for a borrower to say, well, this is the guy who sets interest rates. I assume he knows what he's doing. I guess I can go with a variable rate because it's going to stay low for longer. Obviously, either he was wrong or he was not exactly telling us the truth or whatever. I don't know. But the fact of the matter is, yes, interest rates are a lot higher. So what can this person do? Well, I guess you got to do your own stress test and say, how much higher can rates go when I can still keep my house? He may already be at that point. Now, I guess the good news is his mortgage renews in a year, so he doesn't have to make a decision today. But if he's on a variable rate, the damage is already being done. So the first thing I would consider is saying, well, maybe I should sell my house and find a place to rent. Because again, the house is probably worth more than when he bought it. So he could sell the house, have money in the bank, rent for a while, not have to worry about the high interest rates. Now, maybe he can never get back into the housing market, so that's a decision he's got to make. But I believe he's got a wife, 2 kids. You know, it's expensive. That might be something to consider. It's, again, a difficult decision, though, because this is my house. I did the right thing. I did what they said, and I end up in trouble. My final piece of advice, again, would be you've got time before renewal. You want to be talking to your mortgage professional well in advance. Don't wait till the last week to see what other options are out there.
Okay, let's get to our final question. We may have a little less time for the answer on this one. This one comes from Jody in Manitoba. I'm the parent of a prospective first-time home buyer. My 25-year-old daughter has a full-time job in her field. She's making monthly payments on her car, has no debt, and is finishing another university degree. She lives with us and pays nothing for room or board except her cell phone bill. She's single, and she's been steadily saving for a down payment on a home. What would help? Option 1, a 30-year mortgage for any home buyer. Number 2, lowering of down payment percentage if using CMHC. I'm 52 and my wife is 50. Our retirement plans didn't include our kids still living with us as adults.
Well, and I can't advise the government on what the correct answers are. I mean, the answer is we need to get the money supply under control so we don't have massive inflation, so house prices aren't being driven up. I think for the specific question, what should I do? Should I help my adult child or not? And the answer is, if you've got, $1 million in a GIC and you can give them a $200,000 down payment, it's not going to affect you at all. Great. But if you're going to take on a lot of debt to help them, then I'd be very careful about that. You don't want to toast your retirement to help your child.